You probably don't know this, but according to HMRC, self-employed people are not the only ones who might need to file a self-assessment tax return. You might even need to. There are a few situations where you might actually be liable to pay money to HMRC, and these situations could cause you a lot of grief if you're not careful. So I've put together everything you need to know how to keep you on the right side of HMRC, submit the right information, and ultimately avoid penalties. Let's get into it. Self-employed versus sole trader. To start with, what's the difference? Well, the answer is nothing really. Sole trader describes your business structure, while self-employed is a way of saying you don't work for someone else through payroll, for example. If you're self-employed as a sole trader and you made over £1,000 in income before deducting any expenses during the last tax year, you're required to file a self-assessment tax return, SA 100. It doesn't matter if it's a small side hustle or your main income source. If you've crossed that £1,000 threshold, HMRC wants to hear from you. This £1,000 is your tax-free trading allowance. It's meant to cover casual or miscellaneous income, for example, selling goods online, doing a few car booties, that kind of thing. Basically, bits of casual work which are under the £1,000 threshold. A little tip though, if you're selling online, it's not the amount you receive into the bank in total. That's got your selling fees and commissions deducted. You need to add those back to work out the total gross income. Business partnerships. Next up, partnerships. If you're a partner in a business partnership, you need to file a self-assessment too. Now that includes both traditional partnerships and limited liability partnerships, or LLPs. Each partner has to report their share of the profits, and the partnership itself will file its own return. So if you're in a partnership, self-assessment is a must. High income. Now let's talk about high income. If your total taxable income was over $125,140 last year, you'll need to file a self-assessment, even if your earnings are already taxed through PAYE. This threshold kicks in the additional rate tax bracket of 45%, ouch, and HMRC requires a self-assessment to ensure that your higher rate taxes are properly applied and accounted for. Additionally, if your income was over $100,000, your personal allowance decreases by £1 for every £2 earned over $100,000, which might also require you to file a return. Capital gains tax. Now, moving on to capital gains. If you sold or disposed of assets like property, shares, or other valuables and made a profit, you may have triggered a capital gains tax liability. The tax-free allowance for capital gains is currently a paltry £3,000 a year. So if your gains are above that, or you want to report losses to offset any future gains, don't forget, you can carry those forward, you'll need to report it through a self-assessment tax return. Hardly worthwhile dusting the Van Gogh down out of the attic though. High income child benefit charge. If you or your partner claimed child benefit, and one of you had income above $50,000, you might be subject to something called the High Income Child Benefit Charge, or HICBC. This charge reduces your child benefit by 1% for every £100 you earn over $50,000. And if your income reaches $60,000, you're effectively losing the benefit altogether. Filing a self-assessment is how you actually calculate that and pay back any part of the child benefit you owe. Now bear in mind, each of you can also earn £49,999 and not be subject to that. Untaxed income, renting property, tips, savings, foreign income. Now, if you've got untaxed income, such as money from renting out property, tips, commissions, or income from savings and investments, you'll need to file a self-assessment. Specifically, if you earn more than £1,000 from property or casual earnings, or if your income from savings and investments exceeds £10,000 before tax, you will need to report it. This includes any income you've made from overseas as well, whether it's a pension, dividends, or salary. HMRC basically wants to ensure all untaxed earnings are reported so that the correct tax can be applied. Rental property. Now, a question I get asked a lot is, do I need to file a tax return if I've got a buy-to-let property, particularly if I'm not making a profit? And the answer is yes, but sometimes no as well. The first £1,000 of your income is tax-free. That's your property allowance. So you don't need to file a tax return if it's under that. Between £1,000 and £2,500, you'll need to contact HMRC because you don't necessarily need to file a tax return, but you still need to report it and pay any tax if it's due. If it's between £2,500 and £10,000 before allowable expenses, then yes, you will need to report it on a tax return. The important thing to remember here, and this is in red flashing lights, is that it doesn't currently include your mortgage interest. Through the mortgage interest relief restriction that was introduced a few years ago, that's dealt with in a totally separate way and is not an allowable expense. All right, so those are the main criteria. Now, some of you might be thinking, but my main income is through PAYE and tax is already deducted. And that's a good point. If your only source of income is tax through PAYE, pay as you earn, and you've got no additional income, you probably don't need to file. But if you meet any of the conditions we've discussed, even with PAYE, you may still need to submit a tax return. Check your eligibility. If you're still unsure, HMRC has an online tool that can help. Just head over to gov.uk and you'll find a quick questionnaire that walks you through your situation and lets you know if you need to file. And I've included a link for that here. One last tip. It's important to file if you're required to, because there are penalties if you miss the self-assessment deadline of 31st of January each year. The actual period covered on the return is always 6th of April to the following 5th of April, and then 9 months later is the filing deadline, the following 31st of January. So it's a bit like having a baby, just in this case it's a tax baby. All of the pain with none of the cuteness. So mark that on your calendar if you need to submit.